framework and accounting results are often similar. In other words, they do it similarly. For example, they have to use the accrual basis of accounting for both, and they both use fair value for many assets, such as derivatives, equities, and debt securities. So they're similar in those two ways, and they differ in these ways. The reporting value of property, plant, and equipment for GAAP is historical, but IFRS uses fair value. Fair value is defined a little bit different between the two. When fair value is used on both, there's a little bit difference in the way they are discussed. And again, this is a real nice, tricky question they can ask you on the exam. So I do suggest that you become familiar with or IFRS defines fair value as the amount for which an asset could be exchanged or settled at an arm's length or a face-to-face transaction. And then there are ways that they converge together. What they're trying to do to promote international standards is they're trying to merge the two together as much as possible, and they're planning on doing it by the end of 2016, so that especially for internationally traded securities, those guys wouldn't have to create two different annual reports, one under GAAP for the US and one under IFRS for the international community. That's what they're trying to converge them. And what would the impact has to report under GAAP? So it'd be really nice that if they could do it under IFRS. All licensed insurers are required to file annual statements with the NAIC using GAAP. What does that mean? Any insurance company publicly traded, guess what? 3 annual reports, SAP, GAAP, and IFRS if they're international. That's a huge burden. So that's the impact that it would have on insurance companies. Another thing that is pretty important when it comes to insurers, the valuing their liabilities. While GAAP and IFRS value many insurance assets are valued similarly, a controversial difference between the two is the way they value insurer liabilities. The IASB has proposed a comprehensive global standard for insurance contracts where the liabilities will be measured using a fair value approach when it comes to losses and loss expenses. An exit value would be established for these liabilities. That would be the amount the insurer would have to pay to transfer them to somebody else. And because there's no market for transferring insurance company liabilities, the estimates would often be discounting the cash flow associated with these liabilities. So not a real huge sticky thing, but just something to think about when it comes to GAAP and IFRS with insurer liabilities. Okay, I think it's a good time for a break. Everybody agree? Do you want to take a little break, stretch your legs? Yeah, we're going to take a little break. Did I do that right, Spence? Am I not sharing? Still sharing. Stop my webcam. Hey.